Hey, welcome to Innovate Africa. Today we focus on the funding landscape. It is intricate. PE firms, VC firms, syndicates, you name it. What do they even actually mean? And how do we simplify it? Well, there's a company called Summit that's busy doing that. You are joined by co-founder Ben Dryden. Great having you on. What is your purpose? Why do you exist as Summit?
So if we just take a complete step back, as opposed to like the tech, the functionality, etc., the reason why funds exist and investors exist is because they are great entrepreneurs who are building great businesses that allow them to get great returns. So if we think about how important entrepreneurs are, they create 7 out of 10 jobs, they contribute 40% towards GDP in emerging economies, and they represent 90% of global businesses. So they are without a doubt the lifeblood of our economy and our growth. But every single year, there are 65 million businesses that do not get the funding they need to survive and grow. And that translates to a $5.3 trillion funding gap every single year. And granted, not all of those businesses may be investment ready or high quality, but that is a massive gap where the people and entrepreneurs who should get the funding to scale, grow, create jobs, and create impact are not getting the funding they need. So in essence, we had to support entrepreneurs by providing them with access to global funding to make sure that they can continue to create jobs and stimulate economic growth.
Now, how do you go about doing that practically, pragmatically?
If we think about a couple of the problems, doing a deal now today is very similar to how you would do a deal 20 years ago. It's extremely archaic, it's extremely inefficient. The funds are inundated with applications. So a typical VC is receiving about 1,000 applications for funding. 50% of those are not matched to their exact mandate, and at least another 30% aren't investment ready. So that's just the deal side of things. Then post-investment, you hear all the horror stories of, I've invested into a startup and I've never heard from them again. You don't know what's going on underneath the hood, how do their financials look, etc. So there's a huge lack of transparent data post-investment. And then when it comes to exiting, especially in Africa, the huge problem is liquidity. There's a bunch of corporates who do M&A, but otherwise than that, there's a huge amount of non-circularity of capital. Whereas you look at the US, etc., there are a lot of funds throughout the various stages of a life cycle. And here in Africa, unfortunately, we don't have a massive amount of capital and a huge ecosystem yet. So in terms of how we do this, we've basically created an end-to-end technology platform to raise funding for investors to source, analyze, and invest in global deals matched to their mandate. Then post-investment, they're able to track and monitor exactly how their business is performing in real time. And then when they're ready to sell, they can exit that business on a secondary market. So source deals, invest in the deals, monitor, and then also exit.
Take us through the journey of how you got this off the ground. We love storytelling, so tell us your story.
In terms of background is in mergers and acquisitions, where we're doing a lot of deals, doing growth stage fundraising, helping funds to exit, helping founders to exit, and then also restructuring companies. So our bread and butter was deal making. And it's a service-based business to a large extent, and that's really difficult to scale. So from our side, we said, how can we scale a service-based business? And this was a couple of years ago, almost 3 years ago, and we went down a bunch of different routes exploring how we could scale a service-based deal-making business. And one thing that constantly came up was this whole process has so many bottlenecks, from finding a deal, sending a pitch deck over email, signing NDAs, accessing a data room, but now you've got 5 different data rooms, you've got 500 emails on a transaction, and it's like you have to build technology throughout that whole process to make it streamlined. So we initially started out in terms of how do we solve our own problem, but then through a bunch of market research and years in this market, we just realized that we can actually build a solution for the whole market, for the funds, for the founders and businesses, and then also for all the service providers that service those respective parties. So we built a really bad MVP, or I did. I don't have a technology background, but I built a terrible MVP, but it was enough to go to a few of the VC funds and the private equity funds and say, this is the idea, will it work, yes or no? And we went on sort of a market research process for about 2 years, really refining the product and the idea for the product. And then we got a MVP built. But then the real catalytic moment was we partnered with our tech co-founders who have been building platforms for banks. The founder of their firm was the architect behind Luno and SnapScan and RMB's platform, and really specialized in building highly secure and highly streamlined technology platforms in the financial markets. So we had this idea and an MVP, and they had the technology that could take our MVP from a 3 to 4 year roadmap and cut it in half. So we partnered together. They came on as shareholders, contributed capital and IP, and we contributed our IP and capital, and that's sort of how Summit was birthed. So the genesis of a technology firm specialized in building highly streamlined and scalable platforms, and then the M&A deal-making firm that really has the industry expertise and the network which we can leverage.
If you don't mind, share some of the stories relating to the successes that Summit can brag about, boast about currently.
If we go back to the first point, which was assisting entrepreneurs to get the funding they need to survive and grow and scale, we have launched in mid-September 2024. Since launching, which is about a month and a half, 2 months ago, we've got businesses who are cumulatively raising $130 million on the platform. We have investors who are managing just over $4 billion on the platform, and now it's connecting those opportunities and actually getting those deals closed. So we have 8 deals in due diligence currently, and at various stages of the due diligence. We have some businesses who have connected with great potential investors who may be slightly later stage, because our background is mostly in the later stage investing, and now we're coming into the earlier stages. So from the founder's side is, for their future rounds, they've got great connections to later stage investors, and then we are constantly growing the earlier stage investor base on our side. So as I said, there's about 8 deals in due diligence, and we're hoping to close a deal and finalize that with money in the bank by the end of 2024.
You mentioned late stage investments, early stage investments, they all come at their nuances. What are some of the opportunities and some of the challenges when juxtaposing the two?
Yeah, so firstly, I think there's a huge disconnect between venture capital and private equity, and that people speak about a funding gap in the VC space and a funding gap in the private equity space, but I really see the big funding gap is actually between VC and private equity. There are a few funds who are starting to play in this middle market where they're actually a secondary focused fund. So they're buying up the portfolio companies of the VC funds. The VC funds desperately need liquidity, and these companies need to bridge this gap between VC and private equity. So I think that's one of the big challenges, especially in Africa. If you look at the US, there's a lot of investors throughout the various stages, including in this middle market. But in Africa, we're still in a very nascent stage of our venture capital ecosystem. The other caveat to that is we see a lot of VC funds that have been established on the back of a private equity fund. So if you're a VC fund, you're typically going to be backing the team, backing the market, and their ability to execute. So private equity, you've got a lot more data points to look at. You're always looking for traction, you're looking at revenue, you're looking at customers. But with VC, that shouldn't be as much of the focus. So we see a lot of VCs in this market actually just wearing private equity hats. So they say they're really backing early stage entrepreneurs, but there's unfortunately only a few funds who really put their money where their mouth is and back entrepreneurs from the earlier stages where they really need it. So the pre-seed funds, the seed funds, you're looking at Launch Africa, you're looking at Savant, you're looking at these earlier stage guys that we desperately need them, because if I have an idea and I've got like a little bit of traction, I can't get to a Series A. I don't have $100,000 a monthly recurring revenue. And we need these earlier stage guys to stop wearing private equity hats and actually start taking bets on the actual typical VC model that you see in the US and Asia, etc.
Now, how do you actually endeavor, pardon the pun, speaking of VCs, how do you endeavor to influence that?
Yeah, so I think from our side, if we look at the risk associated with VC, a lot of the time we spoke about it earlier where you invest into an early stage startup and then you never hear from them for 6 months. It's like, well, where's my money? How is it performing? What's my investment looking like? So in terms of navigating that from our side, all businesses that apply to Summit go through a screening process to make sure they're investment ready and high quality businesses. So any deals on platform have already been vetted, so that removes one risk barrier. Then two, the rest of the process is fully automated on the due diligence side. So instead of scraping through 1,000 documents during a due diligence and spending 3 to 6 months on a DD, you can now ask our AI exactly what you need to know for due diligence and get that answer in seconds. So instead of waiting months to make a decision, you can make a very informed decision in a short space of time. And from our side, it's also democratizing access to high quality entrepreneurs and opportunities. So streamline the process to make the investors' lives easier and also the businesses' lives easier, and then de-risk every aspect of the process with transparent reporting, post-investment, etc.
Everybody needs a good partner to go from A to B. Who are the partners that you are looking for in the ecosystem today as we speak?
Obviously, always looking for high quality businesses and high quality investors. So looking at partnering with accelerators, incubators, entrepreneurial programs, also partnering with funds to help their existing portfolio companies to raise capital. So I would say those are the couple core things: accelerators, incubators, funds, and then also entrepreneurial programs who have access to high quality businesses and then also have access to high quality investors.
It's one thing to talk about the VCs and the PE firms, but there are medium net worth individuals, high net worth individuals who actually want to create syndicates. Are they able to do that on Summit?
So it's a very interesting world where I think the typical VC model is going to see some disruption over the next couple of years, because a lot more people want to have a say as to exactly where they allocate their capital. They want to be more involved as well. So I think the typical VC model is going to change over the next couple of years. But in terms of your question with the high net worths and medium net worths who want access to great quality startups, creating a syndicate, we see a lot of that. So from our side, we obviously only allow professional, sophisticated investors. So if that angel syndicate does qualify, they're able to access the platform and run their full deal process on Summit as well. So I think that model is going to be increasingly popular over the next couple of years, where I have, let's call it, a couple $1 million, and instead of investing directly into a fund, I can actually create a syndicate, and from there I control where my capital is allocated. I don't have to wait 8 to 12 years to get my capital back, and I can be a lot more flexible with capital. So it's what we see a lot of the family offices and the multi-family offices. It's similar sort of structure to that, which has become increasingly popular.
So just because you have money, it does not mean you're now to start a syndicate. Is there no way of Summit actually creating a roadmap enabling people to start their own syndicates?
Yep, love the idea. So basically on platform, there are service providers. So if you want to find a lawyer to help you put a legal structure together for a syndicate, you can find them on platform. They can facilitate that. And then from there, we go through the usual vetting process. So you're able to do that currently right now, which is super exciting. And I think in terms of creating these SPV structures, there is an entity in the UK which does something quite similar for angel investing. They ran into a bit of regulatory trouble because they were managing money, etc. Whereas from our side, we're a pure platform play. So you can find the service provider to help you put the structure together. At a later stage, we may do company incorporation, etc. But for now, it's a pure platform play where businesses and funds can raise funding, investors can source deals, analyze them and close them, and then monitor and exit.
Ben, we both know SMMEs run economies, create jobs. Can those SMMEs, the ones who don't want to become unicorns, they want to scale hyperlocally or locally or maybe even just nationally, can they use Summit?
I think that's the nice thing about a platform play is we can be very flexible, and there are a bunch of different investors with different mandates. So for instance, if you are you're not going to be a unicorn one day, you don't want to go the typical venture capital route, growth at all costs, high burn rates. If you want slightly more patient capital, there are the likes of the family offices, the high net worths, the angels, the DFIs, etc., who aren't necessarily only investing with a commercial mindset, but with a longer term patient capital mindset as well. So that's the great thing about the platform is we are not specifically focused only on VC or only on private equity. there is more patient capital on platform through the likes of the family offices, etc.
What are some of the biggest lessons that you've learned as a co-founder in this particular space?
Building tech is expensive and it's hard. It's really difficult to prioritize focus, especially building a multi-sided platform where we, in essence, at the moment, a two-sided marketplace. So you need distribution on one side to get distribution on the other. I think the thing that I've learned about distribution is first-time founders focus on product, second-time founders always focus on distribution. And the thing that I've learned with that is partner with the right partners. Because if you can leverage your partner's network and share in the value that's created through that, it's way better for the ecosystem. And instead of you going and knocking on 1,000 doors, you knock on one door, they open the door to another 1,000. So distribution is something that I never really thought about too much because we were in a service-based business, but now I'm a co-founder. We got to think about our own distribution, and that's a big component. I think the other interesting thing with building tech is just to double click on focus. How do you prioritize value-based features? Because now we've got businesses, we've got investors, we're going to have LPs investing into the funds, we're going to have service providers as well. So how do you prioritize building for each of those four moving parts? So that's been a really interesting challenge, and we've decided to focus on business to investor first, and we can scale the rest from there.
Finally, Ben, I'm sure it's not been an easy road. You've learned a lot of lessons. Can you share some of those lessons with early stage founders? People who are just sitting with ideas, or maybe they've just started a business.
Yeah, I think first time founders, as I mentioned now, focus on distribution instead of just product. And obviously you need product for distribution, but there's a bunch of different ways where you can get traction without having revenue or without having customers, etc. Traction is an interesting word, but basically you don't have to have $100,000 a monthly recurring revenue to raise venture capital. You need a few people that will really just back you and back the idea. And there's actually so many angel investors out there who may not be vocal all over LinkedIn or on summits or wherever they are. But basically my point is that you never know, one or two people away from you in your network, they would really be willing to back you with some capital. And I guess my advice would be don't be shy to ask. You never know what can actually come from it. So the last thing is, in order to be interesting, you have to be interested. So when dealing with the likes of investors, etc., don't go in a completely transactional format of, hey, this is my business pitch, I'm going to tell you all about me, I want something from you. Change that narrative where actually try and leave value on the table for the investor as well, whether it's a bit of knowledge, whether it's some market mapping or expertise here and there. So it's not a transactional conversation anymore. I think that's a big part of this industry that does go wrong, is it's very transactional. What can you do for me in the immediate term? Whereas this whole industry is built on relationships. So rather build for the long run, try leave something on the table in terms of knowledge or something else that you can actually give back to an investor, and don't try take all the time.
Ben, thank you so much for your time. Always a pleasure chatting to you. And that's really what it's all about. It's about people like Ben and his partners at Summit making sure that those businesses, those innovative businesses who impact lives, have better access to networks, better access to funding, so that they can accelerate the good work that they do. I'll see you next week on Innovate Africa.